What happens when venture capital becomes so commoditized that your euro is worth exactly the same as everyone else's?
There's just too many funds out there that are too generic, that are kind of Me Too funds that just try to replicate what has worked in the past.
While VCs chase the same deals with the same pitch, one investor is rewriting the rules entirely.
We're not going to look into, you've got 10 users of that particular company, so we're going to charge you X, Y, Z. But it's going to be more outcome driven to the extent possible.
Gloria Baeuerlein discovered the secret isn't fund size, it's strategy first.
The one thing I've seen work for me is think about your strategy first and build it around your strength, and then think about fund size.
Her obsession? Proving she's worth every euro invested.
And I want to make sure that when we go into a partnership together and when I make a commitment, that I feel like I'm the best partner for them on their journey, or how I call it, I'm the best value per euro invested.
As a solo GP, she's turned constraints into competitive advantage.
For me, as a solo GP, I don't care about seeing everything. I literally don't.
But here's the twist. She calls her biggest strength a fundamental flaw.
When LPs ask me about it, I always tell them the fact that I'm a solo GP is a bug, not a feature.
How does an investor turn a bug into the future of European venture capital? Join us for this episode of the European VC podcast as we dive deep into the differentiation crisis reshaping venture and discover why the solo GP model might be the answer everyone's been missing.
Here's a few words from our beloved sponsor. Discover where operational expertise meets innovation. With end-to-end coverage across fund admin, tax, accounting, compliance, ESG, and more, we take care of the complexities so you can focus on what matters most. Whether it's supporting visionaries or maximizing returns for your LPs, our tech-driven and comprehensive solutions empower you to achieve your goals with confidence. Partner with ACE Alternatives to streamline your operations and elevate your fund success.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome back, everyone, to the European VC podcast. Today, I have Gloria from Puzzle with me. Gloria, welcome to the podcast.
Hey, thanks for inviting me.
We're going to talk a bunch about the state of the current market and where we're seeing things move in the state of European venture. But before we go there, I'd just love to ask you to give us all a bit of an update on Puzzle. And to those that have been under a rock and haven't gotten the grip of what Puzzle Ventures is all about, definitely go get them.
Yeah, sure. And so I started Puzzle at the end of 2022, beginning of 2023. With the idea to really help founders put the puzzle pieces together. For me, the puzzle pieces would be like helping you start a company and like really get started with the operations, but then also hire the first employees, figure out who your customers are, helping you find the first customers, and then also helping you find the first investors that are backing you. I created Puzzle from like my experience as both a VC at a multi-stage fund called Index Ventures, and then as an angel in 27 companies across 12 countries. And I really wanted to combine the benefits of what a VC fund could bring and what at the same time an angel could bring. And I think we're going into that later today as well. I really thought there was someone missing in the ecosystem, like that could really combine both benefits. And so now started investing at the beginning of 2023, made 10 investments. Most of what I do is really inception round investing or very, 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 very early stages when there is a product, maybe the first kind of design partners. And every once in a while, I also invest at typical seed stages. All of what I do is B2B. And within B2B, it's really three topics. First topic is kind of infrastructure. Second topic is digitization of traditional industries such as manufacturing, energy, construction. And the third topic is automation of back office processes. And it's always a combination. Some of them are AI native. Some of them have a better value proposition because of AI, because you're not just selling software, but is also selling labor or outcomes. And some of them are really traditional B2B SaaS.
Everyone is talking about where is SaaS, the traditional good old SaaS, going to go in the age of AI? What's your take? I mean, you obviously with the themes that you're investing in described here, B2B infrastructure dev tools, as you just said, digitization of the traditional industries and automation of back office processes. There's a bunch of AI application there, but I can also imagine that there's a similarly large focus on SMEs compared to maybe the larger. But you can correct me there.
So for me, software is not going anywhere. The question is how that software is going to be delivered and how that software is going to be priced. And I think that's what's definitely changing massively. Meaning delivery means for me, are we going to have systems of records? Are we going to have systems of engagement? Is there going to be a front end that like people are gonna log into, etc.? I don't think that's what it's going to look like. I think really it's going to be a couple of agents where you can interact with the agent as an employee at a company, and you can steer them, you can correct them, you can check on them, etc. But we're not going to have like a very static front end anymore for the vast majority of applications. That also means that we won't care as much anymore about who is logging into the software. And so this kind of idea of a user is, in my view, for most categories, going to change massively. And we're not going to look into, oh, you've got 10 users of that particular company, so we're going to charge you X, Y, Z. But it's going to be more outcome driven to the extent possible, right? I think a lot of startups are still struggling with like figuring out what actually the outcome is, what the value is that they're driving, and how much they can take of the value that they're creating. But I think it's going to go more and more towards an outcome-based pricing, or the revenue that they're saving, or the additional revenue they're generating, and they're going to take a portion of that, which is why we're not going to see user-based pricing anymore, but more usage-based pricing. So things will look differently, but ultimately, there's still going to be software or software-hardware combinations below them. So I don't think software or application software is going anywhere.
Do you really see the model becoming that you're charging on a output basis, so to say, a value delivery basis?
Yeah, that's like not in every single category. I think there might be room for some systems of record that are basically storing a lot of the data, coordinating, and have different agents on top. And these agents could be agents that these systems of records built themselves, but also third-party agents. So I think there's definitely going to be more traditional ones as well, and those will be charged on a, I don't know, per revenue basis of a certain company. But I definitely see when we're talking about the agents themselves, a lot of them are outcome based. So for example, when I look at my portfolio, I invested in a company called Gradient Labs, which is doing customer support automation, but not just the frontline customer support, but also the back office operations that are getting triggered by those frontline conversations. And it's definitely easy for them today to charge per completed customer support call/chat. And that's definitely what the customers also want. The question then is, which is something I'm seeing definitely a lot of my portfolio founders still experimenting with, what do you call success? So do you, for example, charge on a successful customer support interaction, or on any type of support interaction? What is considered an interaction? Is it just a customer reaching out, but you're not really having a real conversation? So that's still hard to measure. I think we'd definitely see more and more of experimentation there, but it's definitely moving more towards what's the amount of people you can save within a customer support team, or what's the amount of conversations that the software can cover, for sure.
You mentioned Comstruct, and also I know you've invested in this space of the built world a little bit. And one thing that I know from another episode that I did with Patrick, from Patrick Hellerman from What's the firm? Fundamental.
Fundamental.
Great guy. What he says is, when you look at construction, what you really see is that everyone is used to buying on a project basis there. And for that reason, when you sell to them as a startup, that is what you also need to sell. So if you come in with a SaaS model, they will not know how to buy it. And I'm just putting the pieces together here. Now you're saying that AI is actually likely going to be sold on a output basis, outcome basis, which kind of looks like a project, because with a project you buy the outcome.
Correct. It's exactly what we're seeing on Construct as well. So one of their core features or functionalities is invoice reconciliation. So they basically take the delivery receipt and compare it with the invoice that a building material supplier sent them. And then they can see the inaccuracies, because they can tell, oh, wow, they only delivered 50 kilos of cement, but I was charged for 60 kilos. Maybe I should ask for a correction, right? And here, it's definitely at least going towards invoices that have been reconciled. And it's probably over time going to go towards how much money have you actually saved them by finding these inaccuracies. And it's definitely something we are going towards. It's not like how many finance people are working within the accounts receivable, accounts payable department, and how many are logging in, because everything is effectively being done in the background, or 80% of the work is being done automatically in the background. So that wouldn't be a good way to price it, but it's at least going towards number of invoices processed. Ideally, you even want to get closer to the outcome over time and look into amount saved.
Okay, so that was an AI detour that we all have to take once in a while. But let's run away from it and try and not come back to it too much, and instead shift to the big topic of the changing face of the VC ecosystem in Europe. I know this is something that is keeping you up at night, and also I'm sure one of the raison d'etres behind Puzzle. But maybe let's open with the question: why is this question keeping you awake?
I think I'm very passionate about thinking about differentiation, both when I look at founders and what's the unique insight that they have and how do they differentiate in a very competitive marketplace. And I actually think with AI, it's getting more and more competitive rather than less competitive. And I think the same is true for venture capital. I think ultimately the core of what we're providing, which is capital, is a commodity. Like my euro is the same euro than someone else's euro, right? And so I think you need to be very thoughtful about who you want to work with as a GP. Like, who are the founders that you resonate with? And then for those types of founders, why would they choose you over someone else? It's always something that I've been like super obsessed about and super passionate about, because I don't want to feel like, oh, I just shuffled the money down their throat and they feel like they didn't really, there would have been a better partner for them who could have given them the same amount of money, who would have been a better fit. And I want to make sure that when we go into a partnership together and when I make a commitment, that I feel like I'm the best partner for them on their journey, or how I call it, I'm the best value per euro invested. So hopefully someone that invests 10 times as much as I do, or 8 times as much as I do, provides more value than I do. But I try to really think through, okay, can I genuinely be helpful here? And am I really the best partner for that kind of founder, for that kind of business, etc.? And that really depends on who you want to partner with, who you gravitate towards, what type of businesses you like. And I think you should be aware of that first and then structure your fund around it. I think there's just too many funds out there that are too generic, that are kind of Me Too funds that just try to replicate what has worked in the past. But they don't realize that brand is really, really, really powerful in VC. Just because you're replicating something that someone successful has been doing for the past 20 years doesn't mean that you're going to be successful with exactly the same strategy. So I'm just obsessed with like finding my own way and kind of building puzzle around who I am, what I like, my strengths and weaknesses, etc.
Yeah, I think that is very smart. I was just about to find, because you mentioned brand, I had I just received a cocoa in a pink wrapping paper,
Wow.
cocoa bunny from Carmen.
Is that a child or is it like a
She
baby
sent
bird?
she sent that for my dear little daughter.
Wow.
So thank you, Carmen. Shout out to you for that. And I absolutely agree with you. Obviously, brand is one place to differentiate, and Carmen is one of the people that really do it well. I'd love to ask you, how do you then think about this differentiation point? Because everyone talks about it. The way I frame it is, the way LPs think about it is, they call it what's your edge as a VC? What makes you different from everyone else and stand out? However, I think a lot of people have been trained to both ask that question, but also as VCs answer that question. But I don't think there's a lot that then come up with a very powerful answer, meaning that they then default to saying, well, this is my value add, or I focus on construction tech or whatever. And then it becomes a bit of a hollow answer compared to, and I did a full episode with Patrick Helleman that we spoke about just before, about his edge framework, and we kind of co-developed an iteration of it that is going to go out, where we kind of describe it as you have these 7 questions, 7 layers that you want to go through. I'm really missing that depth to people's answer when I ask, but I'd love to ask you how you frame it.
Yeah. So I don't think I have all the answers for everything. And I agree with you. You have to kind of go one step deeper from like what's actually your value proposition. The one thing I've seen work for me is think about your strategy first and build it around your strength. And then think about fund size. I feel like a lot of people that I also talk to, they're thinking about, oh, how much can I raise? And then they try to retrofit the strategy into it. And in a lot of cases, I also have the feeling that they are looking into who can I raise from? What do the LPs want? And then they're creating the strategy around it rather than this is actually what I've been passionate about all my life. This is what I've done. This is what I understand. And then look for LPs in that particular area. So I think for me, it was really important to think about like, what have I seen as a VC and as an angel? And how do I think I can play to my strengths to fit in? There's probably 2 things that I've seen in my years as a VC and as an angel that really shaped the way I thought about puzzle. One was that when I was at Index, which was like beginning of 16 to the beginning of end of 18, the seed funds, there was a clear division between what the seed funds would do and what the multi-stage funds would do. And very rarely would we really invest at seed stages. Like we would basically wait until the companies were close to $1 million ARR, and then we would lead the A's and the B's and so on. And then what I saw when I went to the operational side and became an angel, I saw multi-stage funds going earlier and earlier. And I think it's a combination of them raising more capital and like raising dedicated seed funds, such as Index, but also it was a function of the US funds coming into Europe, starting offices here and more actively investing in Europe. And so it was all of a sudden a lot more competitive at Series A and Series B. And so you kind of knew that would be harder and harder to get in if Sequoia would already be in. And so you're going earlier and earlier. And then I concluded that I think it's going to be a sustainable picture that the vast majority, not all of them, but the vast majority of multi-stage funds will continue to invest at pre-seed and seed, particularly for experienced operators and repeat founders. I don't think they do it if you've got like a 24-year-old Henrik at Construct or a 26-year-old Tristan at Rionic. I think they'll still struggle with that. But if you have like someone that comes out of Stripe or Monzo or whatever, they're happy to do pre-seed and seed. And I basically felt like this would continue to be the case. At the same time, I saw that a lot of seed funds really got professionalized and were raising more and more capital. In like 16 to 18, we had the first couple of professional seed funds, like Local Globe, I think got started in 15, and then we had Cherry Ventures, and you had all these funds. But they were getting larger and larger over time, also because they got a lot of funding from like EIF, BPI, British Business Bank, whatever it might be. And so all of a sudden they realize, oh, wow, now we also have to play the ownership game. Now we also need 10, 12, 15% ownership. similarly to the multi-stage funds. So they can no longer collaborate. And that was definitely something I saw, that while it was very common for us to have a very close relationship with Cherry and effectively mark up all their portfolio companies, now all of a sudden they were kind of competing one level earlier. And that meant that the seed funds were really going into pre-seed territory, but also directly competing with the multi-stage funds. And so I felt like the typical round would look like you have 20% dilution, you probably have 12 to 15% for the lead investor, and then there was 5 to 7, 8% left for followers. And those followers were a combination of either very small seed funds or like angels. And there was always this opportunity left. So that's definitely something that I saw on that end. That was one trend. The other trend that I saw while I was an angel was that a lot of operators started getting some money, some secondaries from the companies that I worked at. And they wanted to give back to the community. They wanted to give back to the ecosystem. They started angel investing. But to be honest, because they were doing it part-time, and because usually their networks were quite geographically focused, they were not necessarily building the optimal angel portfolio, what I would call. Because it would be like friends and family kind of investments and like ex-colleagues locally, which makes sense if you have a very limited amount of time. But it might not necessarily make sense from a portfolio construction point of view. And it's also not necessarily the best setup for the founders to only have local angels, to only, if you're a German founder, to only have German angels. And so I really felt like there is a need to professionalize angel investing and to jointly invest collaboratively across Europe and bring everyone together. And for me, those two trends were kind of why I started Puzzle.
I just had a thought here. I want to ask you a maybe slightly provocative question. Is it right to say that if you raise a seed fund today, your primary competition is existing seed funds and multi-stage funds? Whereas if you raise a solo GP pre-seed, your primary competitors are other angels.
I think the first one is true if we're talking about application layer AI / SaaS. It's definitely true. Yeah. I think there is still significant room for very, very deep tech, like hardware focused seed funds where you will find very little competition with the multi-stage funds, because the multi-stage funds, they're all generalists. And like once you go to the edges, they're not going to compete with you at pre-seed and seed, and they definitely need traction. Yeah. I think for the core generalist type of investments, it's definitely true. For me, it's really mostly the large angels sometimes, and sometimes the other solo GP funds. Yeah. But in reality, it's quite interesting. I mean, you talked about Carmen before, and I was with her on a panel recently, and we realized like we're not really looking at the same stuff. It's quite interesting. So like while we look the same, while our fund sizes are similar, while probably our proposition is very similar, the market is still so large and so broad that each of us have like different preferences of like what we're looking at. And so in reality, there is not a lot of overlap where we would actually compete. And in 95% of the cases, we will actually be super collaborative and we can jointly invest. And then there might be this one case where we're competing, but none of us is obsessed about it. So I would never really like even call her competition. Like I respect her a ton, or like Anthony or Felix at Boom or whoever it might be, right? But in reality, in 95 to 98%, we are really friends.
Yeah. And the reason I asked Gloria the question in the way that I did was in the hopes of making it maybe a little bit abundantly clear that raising a solo GP to do pre-seed is probably a better idea for a lot out there than to raise a 3-man team or whatever for 50 or 60 million at the seed stage, just because it's the competition there is so much easier.
You have a lot more optionality. Yeah. So when I look at my 10 investments, 3 of them are with multi-stage funds from the get-go. 4 of them are with seed funds, and 3 of them are just with either micro funds, solo GPs, etc. And so I can fit into everything. And I really have to care about, want to work with this founder? And then obviously, if the allocation would be too small, I would also be like, it doesn't make sense anymore. But it hasn't happened so far. I can really completely focus on that. On like, do I want to work with this founder? Do I believe in the mission, etc.? And not about anything else, really.
But then let's drill down on this, the model of the solo GP then, because I don't think we've spoken enough about that on the podcast. And there's not a lot that have your type of experience coming from a multi-stage fund to then, and then at the same time have done angel investments to then say, okay, I'm going to go full on pre-seed, because that is a very unique perspective to invest from, because you've seen how index operated, you've seen the decision-making processes, you've seen how they describe themselves to the market. Can you tell me a bit about, reflect on the operating model of a multi-stage firm or even just a seed stage firm and being a solo GP?
So for me, it's all about, as a multi-stage firm, especially when you have a brand in the market, you basically need to see everything. And you need to look at everything and take everything seriously. For me, as a solo GP, I don't care about seeing everything. I literally don't. So for me, it's about, I need to get an idea of where the market is at. I need to get an idea of what other people are looking at. But then I'm actually doing a lot of references top of the funnel. And I'm like cutting things out super top of the funnel so I can take a couple of high quality intros and high quality conversations and really focus on figuring out with like maybe about 20, 30 founders a month, whether I want to work with them or not. Versus if you are a multi-stage firm, everyone wants to talk to you. And you get a lot of pings and you probably have to look at everything. And you kind of need to be a little bit paranoid to some extent, right? And so it's a very different way of operating, to be honest. And then at the same time, you also have to look at different stages. So it's not a single shot. You can also invest at later stages. So there's always a reason for you to pass on something. Because it can always feel like, I want to see more, and then I can correct my mistakes later down the line. I don't really have that. Like, I'm kind of, for the vast majority of companies, there is one round that I can really invest in when they're successful. Because there was a company recently that I looked at pre-seed, and then within 6 months they raised like a 10 million seed now, and definitely the 10 million seed is not something I could look at. So if they're really doing well, there's no way for me to correct my mistakes, which is very different from a multi-stage fund, and so they can think about things in a very different light. And then the third one, where I think they're very different, is something that kind of frustrated me, but it's I can understand where they're coming from. For a multi-stage fund, a unicorn exit is no longer cutting it. The funds are just so large that they really, really need to back the decacorns, the generational companies, etc. Because otherwise the fund model doesn't work. And so they're very sensitive on ownership, but they're not sensitive on valuation because they don't care whether they invest 4 million or 5 million to a company as long as they can get the ownership and then deploy more capital over time. And that's obviously very different for me. So probably the one company or the one type of company that I can invest today in, that they can invest in, is the really like the foundational models, the companies that are raising at like 100, 200 million post-money valuation at pre-seed. I understand why it makes sense for them and their fund model because they can deploy more capital over time. And it just doesn't make sense for me. I don't need the branding. Versus if you are a multi-stage fund, it's really important that you can signal that you are in the vast majority of the relevant companies of a certain generation, right? And so you might be thinking about valuations differently than I will need to think about things.
One of the strengths, as you describe, is for you that you don't have to look for these necessarily banger hitters that all the multi-stage firms will love. But it also means, and this is a funny question, right? Because the fact that you're not looking for those overhyped assets also means that you don't as naturally end up in the same deals as these big logos that everyone loves to throw around. How do you think about that? And I'm asking you like I'm maybe putting the words in your mouth because there's only one right answer, and that is all I care about is DPI. But the reality, however, is that, venture is very much of a game where you are trying to match your fundraising narrative and everything connected to showing traction before you have DPI, to then also having the investments that really do end up returning money.
I mean, in reality, also a third of what I do is with these multi-stage funds, right? And these multi-stage funds, they are also marking up some of the companies where I invest pre-seed, and then they come in the next round, etc. That's definitely what I'm looking for. And I'm not gonna look for 200 million, 300 million, 400 million outcomes either, because it also doesn't work for my model, to be honest, with 2%, 3% average ownership. But like there's a small line, which is really the extreme companies, the Mistrals of this world, the Age Company, etc., where I can see how it makes sense for them because they can deploy at growth stages over time. But these types of companies just don't make sense for me. So it's really only the very extremes. But that doesn't mean like I'm not very valuation sensitive, like to a certain extent, right? So I don't care whether it's a 12 million post or a 13 million post or a 12 million or 15 million post even money valuation that I invest in. Because I think that's the one thing I learned also from both from Index, but also from my own angel portfolio. I think you should not over optimize on entry valuations as long as it's within a certain range. But obviously, if I invested 80 million post at pre-seed, I also need to think through, oh yeah, it needs to exit at 8 times the size of a normal company that I can invest in at pre-seed, right? And while I think a lot of these companies that they invest in, they're definitely better than like your average pre-seed or a seed opportunity. But for me, the question is always like, is it 8 times better?
Yeah.
And
Is the
if
return
you
profile better?
Correct. And if you can deploy hundreds of millions over time and then have a decacorn exit, and that's like that might be the right strategy for a multi-stage fund. But it's very difficult for me because I can't invest at the Series B and at the Series C and at the Series D.
Yeah.
It's not my job and it's not part of my fund model, right? And so those are the ones that I'm like trying to shy away from today.
You mentioned your fund model a couple of times, and specifically you said, I'm not looking for the 2, 3, 400 million exits either, because that doesn't work in my model. Maybe could you just unpack the exit assumptions that you have, or the model in its totality?
So the fund is about 21.5 million euros in size. And I
Good
basically
round
invest
number.
and I basically invest between 200,000 euros and 700,000 euros initially. And that kind of translates anywhere from like 1.5 to 4% ownership. Because that way I feel like I can still ideally work with everyone. And so the idea that I have is the initial ticket, or the initial and actually the one follow-on ticket, always needs to enable me to create a fund returner. So because if you look at any statistic, roughly speaking, if you want to have a 3x net fund, which is definitely something that I want, especially with my fund size, you have to have at least one fund returner in the fund. Otherwise, it's very unlikely that you'll return 3x net. And so I'm really obsessed with this idea of, with my initial investment plus one follow-on, can I really return the whole fund? And so
And
in ideal
now you
scenario,
said something important with one follow-on. Is that because you like to exit after one follow-on, or is it just because that's the level at which you, so to say, calculate it? Because after that, it becomes, who knows?
I think there's two aspects of that. One is I want to make sure that the average entry valuation of the fund is not that of a Series A fund, and that the average is somewhere in like the 50 million range, like somewhere between a pre-seed and a seed fund with some Series A in there. So hence you can't do too many follow-ons from the same fund. So it's really, really important for me that's kind of what you're buying also as an LP, what the product for the LP is. And at the same time, I do not think I want to spend all my time thinking about putting more money into Series B or Series C, because I really want to spend all my time like helping the founders make sure they are successful in their journey. And I don't try to optimize for how can I make the most absolute amount of money. I'm obsessed with creating the highest return fund, but I'm more obsessed about it because I think that enables me to then invest in even better founders in the next generation, etc. And I really want to do right by the LPs that believe in me, but I don't care about whether I make an additional amount in carry that I could get through investing in a Series B that then might return 2x or 3x. It's just not something I want to like care about or spend too much time on. And so the fund is really initial investment and follow on. But the idea is to stay in for at least 7, 8, 10 years and really go on the journey with the founders. But there is definitely the benefit of having low ownership that if I want to, probably at Series D or Series E, I could do a secondary. Like if you've let the Series A, it's a very, very hard to sell your 15% stake at Series D. But as a solo GP, actually, one of the benefits is that if you own 1 or 2 or 3%, there might be some opportunity for secondary later down the line. But for me, that doesn't mean I want to exit at Series B or even Series C. But maybe it might be pre-IPO, depending on also how the founders think about their cap table and whether they want to clean up their cap table at some point in the future.
What is your rule around, if you have any, around taking a bit of money off the table in the rounds that come?
So there is no strict rule for me because the idea is really to be close enough to the founders to also make a judgment call. And for me, it will really depend on how close I am with the founders down the line. Meaning, if I have a very close relationship with them and I know where they stand and I have somewhat of an insider knowledge and I feel good about where they're going, and that's what we probably need to do if they raise a follow-on round, etc. I would probably prefer to stay in and go on the ride with them because ultimately, when you look at the typical fund construction, it's really the 1, 2, 3 outliers that generate the whole fund. And my LPs and also we're driven by money multiples. We're not driven by ARR necessarily, which I think is the right way to look at it for a small fund. Very different if you're running a billion fund and your LPs are pension funds, etc. Right? And so in the ideal scenario, I'd like to stay in as long as I can and probably at like a billion valuation, start putting some money off the table, but like very, very, very cautiously. Those changes, if they're for some reason, I don't feel like I have a very close relationship with the founders, which can definitely happen if you own 1 or 2, 3% of the business, right?
Yeah.
In which case, I would probably feel more comfortable selling a larger proportion of the fund of
Your holding.
holding in the company, just because I'm not close enough probably to have an opinion of whether I should stay in or not. And in that case, you probably rather want to leave the cap table.
In other words, you do not have any rule or thought around taking off the initial invested amount in the when you hit 3x on the investment or something like that.
I think it's almost impossible because sometimes you hit 3x or you hit 10x and it just feels like it's a super fair valuation.
Yeah.
I've done growth. I think I have an idea of like what a fair valuation needs to look like at Series B or Series C. And sometimes the company goes from 0 to 1 billion in 2 years and you feel like it's a very frothy valuation and it might be good to take money off the table, right? So I think heuristics are very, very, very dangerous in venture because a 1 billion value business can look very different and can have a very different risk profile.
Yeah.
And so I think it's very difficult to say, oh yeah, at $1 billion, I'm definitely going to sell 50% or whatever. So I really want to do it case by case. I'm not opposed to taking money off the table, but in the ideal scenario, and if I have a very good relationship with the founders, I'd like to stay on board. And it's definitely the kind of default for me is to be there for them for the whole journey.
Yeah. I want to ask you, Gloria, if you're planning for Puzzle to always be a solo GP, but before we go there, I think there's a nice segue from what we just spoke about, which is how do you and who do you lean on to help think through some of these things? Because that is sometimes a harder thing when you're a solo GP. You're the only one there.
I think there's two different aspects of it. One is investments and one is firm building. For investments, the beauty of being collaborative is that I can speak to everyone. It's actually quite helpful to speak with principals or junior partners at the other firms that are also looking at the same company as I do. And they also need to come to an investment decision or not. And kind of just mingle with them and like talk to them about the concerns and the references and really try to understand how they're thinking about things and really kind of sharpen my own investment judgment. And so I don't feel lonely at all. It's been actually very, very interesting to see how people are collaborative, how easy it is for me to talk with Fund A about this fintech opportunity today, and then 2 hours later talk with Fund B about a AI infrastructure company that we're both looking at, and really benefit and do crowdsourcing of ideas. And luckily enough, because I've been in this industry for 10 years, I have a couple of people that I've known for many, many years and that I even would call friends, and that I really, really trust. And so that is not a problem. I think the harder part is the firm building. Like, who do you rely on firm building? How do you decide on, do you want to have a public profile and want to be like all over the press? Or do you just keep calm and you're not really doing a lot? Like, what's the value proposition? What's the size of the next fund? Are you going to do any of these crazy deals because it might be good for branding reasons? Those are the harder questions. And it's a combination of, I've got a lot of like informal mentors that have built funds before me, and I've really relied heavily on them, and they've been super gracious with their time. And some of them are also LPs in the fund. And so they kind of know what's going on broadly, and that's been amazing. And then also some of my LPs, they've invested in multiple funds for 10, 15, 20 years before, and really relying on them around like, hey, can you also introduce me to fund managers that you think do a really good job at reserves or any of these topics? That has been tremendously helpful as well. And then there's an amazing network actually of other solo GPs. And we recently hosted like a solo GP summit, and we'll do it again in a couple of months' time. We just all come together and we're kind of crying on each other's shoulders and like trying to figure out how to do certain things, right? And it's more about the firm building side of things than it's really about investment decisions.
That's exactly why we do our track, right? I invited you for it as well. We just bring 20 founding GPs together because there's just this whole set of considerations you have as a founder of a VC firm that are just different from anything else. And sometimes you have LPs you can draw on, sometimes you don't. Sometimes you already have found the people that are important for you, and sometimes less so. So I really think it's important, and I love the community the solo GPs in Europe have built around themselves, because I think you've done a really great job in connecting you and making sure that you have a group of other peers that you can spar with. Now I want to ask you the final question then. Do you see Puzzle being a solo GP forever?
When LPs ask me about it, I always tell them the fact that I'm a solo GP is a bug, not a feature. Meaning, I'm not obsessed about being a solo GP. It's not something that I'm like, this is the only way to run a firm and this is how it will always be. Just when I started and when I realized like these like trends, there was no one that I was really super, super close with, that I had invested with, that I felt like I wanted to do this for the next 15 to 20 years. And so I just got started, to be honest. It wasn't more than that. I think it's very, very difficult to find someone that you're truly, truly aligned with. And for me, it's very clear, if I would add someone, it would need to be an equal. I don't want to hire a junior person, because I think one of the benefits of running a solo GP firm is that the founders are talking to the decision makers from day one, and they don't have to go through the ranks of different juniors. And so I really want to have a complete equal. Probably we're going to make separate investment decisions, because I don't believe in consensus at pre-seed. And so finding that person is just going to be very, very hard. And I want to take my time to find that person and to understand, like, who do I want? Is it someone that's very, very complementary to me? Is it someone that's probably very similar to me? Is it someone that's more, has like an operating background, or someone that has an investing background? Just finding that person, it's kind of a marriage, right? So I want to take the time. It's not a default for me to add someone, but it's also not a default for me to just be a solo GP forever. The one thing that's pretty clear for me is that I want to stay collaborative with others. And so there is a limit to the fund size. Don't know quite how much it is. It's probably like in the 40, 50 million range, even with 2 partners. And so it's never going to be a large firm, but I would definitely not be opposed to adding someone else.
So a bug, not a feature, but yet still a feature or a bug that heavily defines you in the ecosystem. Very interesting. Gloria, thank you so much for joining me for this episode. It was good fun.
Thank you so much for inviting me.
Here's a few words from our beloved sponsor. Discover where operational expertise meets innovation. With end-to-end coverage across fund admin, tax, accounting, compliance, ESG, and more, we take care of the complexities so you can focus on what matters most. Whether it's supporting visionaries or maximizing returns for your LPs, our tech-driven and comprehensive solutions empower you to achieve your goals with confidence. Partner with ACE Alternatives to streamline your operations and elevate your fund success.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.